What's up, everyone? We've got Jerome Powell gonna be coming to you live 2:30 Eastern time. Until then, we're gonna be sharing the heat map. We're gonna be asking questions, getting you answers. I'm gonna be getting things set up right now, so just give me a few more moments. Put your questions down in the comments section. Hey, we got some people already chiming in saying greetings from Toronto. Well, greetings back to you from South Carolina. Let's get you back to the music. I'm going to get things set up and get you ready for Jerome Powell and the Fed. All right, and we got a few fans chiming in. Level of Madness, Nico, Ben R saying hello to you all. Now remember, Jerome Powell and the Fed gonna be here 2:30 p.m. Eastern time. Just getting a few things set up in the background. Let me know how. We got Nico saying that Danelle Dixon's thing was set up for today. Let me see here real quickly. So let's go to Twitter real quick. I didn't know if her hearing was rescheduled, but let's see if they got anything here. And it would be under the Senate Ag Committee. Let me see if I can find anything on the Senate Ag Committee. Give me a second, everyone. And again, Jerome Powell will be at 2:30 Eastern time. We also got Scooter in the house. Ben R saying 75 or 100. What are you guys thinking? Okay, look. Let's just put it this way, and let's change things up here. We're gonna change up my feed just a little bit, but I'm gonna put it to you guys this way: 75 or the 100 basis point hit. What we need the pain to be over with. We need the Band-Aid to get ripped off, all right? And now let's just put it this way. I'm not saying that a 75 basis point hit is not a big deal. Let's be honest here. Back-to-back-to-back ones, like, that's nuts. That is freaking nuts. You know how much that increases home loans and all that kind of stuff? How much that increases car payments, stuff like that, businesses, all development, all that kind of stuff goes up. And it just knocks out the consumer, right? It knocks out the demand part of it. I don't know. I'm sitting here. Part of me, let's just hit the 100, get it over with, and let's move on. All right, let's make this just our hole. Let's dig it, and let's move on. All right, let's drop 100, see if the next CPI report or the one after that yields good results, and then move down to maybe like a 50. But honestly, even a 75 is rough. Think about it. 75 over the last 3 hits, 225 basis points. That is a lot of interest added to loans. That's a lot of money coming out of the pockets that are going to be buying cars in the next few years, homes, home equity lines of credit. Credit cards are tied to interest rates here in the United States. So I don't know. Nico saying in says 50 basis points will be the best surprise for the day. If there is 50 basis points, I'm telling you, markets are going to rally. And real quick, I don't want to mess up my feed or anything, but if someone out there can do me a favor, look up and see if the House Ag Committee was rescheduled for today. If it was rescheduled for today, let me know in the comments. We can try to see what we could do, split it up, but I don't want to leave the feed right now. So if someone could do a little research for the group here, see if Danelle Dixon's House Ag Committee was rescheduled for today. I didn't think it was. I didn't hear about it, but I've been prepping for this all day, so I may have missed it. Scooter chimes in, and what's up, Scooter, saying 50 would be the year surprise. Yeah. Seriously, if it's a 50 basis point hit, markets are going to rally. The plain and simple, markets will rally because they would say then, hey, the Fed is respecting the 8.3% that we saw for the CPI on the last score. But my thing is this, the 8.3, there was some rough ones in there. Energy was 20, I think like 20.6%, somewhere around there. Food was like 11%. So when the Fed looks at this and the Fed goes, hey, in order to stomp out demand, we have to tackle the things that really are, demand, based. Well, what is that? Food, energy, right? Stuff that affects the consumer a lot. So I think they're looking at this. I think they're putting more weighting on those two parts of the report. 75 is it. I think 75 good money's right there, 80% base, probably 75, 20% base, probably we get 100%. I do not see a 50 basis point hit, nor do I see a 125. But honestly, let's be real here. Ooh, geez, almost knocked my drink over. From what we've seen from the Fed, okay, is this. The Fed themselves have always been behind. Do you guys remember a year ago when we were doing these live streams and we were like, dude, seriously, when is the Fed going to stop, right? The quantitative easing. When are they going to stop, the zombie company prop-ups? When are they going to start raising rates, right? We can't keep putting money out there for so cheap. Fed didn't do anything. Fed said, hey, we're going to watch reports. We're going to watch stuff, blah, 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 all that kind of stuff. And guess what they did? They waited. They waited, and here we were as consumers, right, as people out there going, whoa, stop, no more, stop this. And yet the Fed is like, no, 30 billion a month, not a big deal. Let's just keep adding to our balance. Okay, no big deal. Now all of a sudden they're like, well, we got to pump the brakes on it. So for us, a year ago we were talking about let's start seeing some quarter. Let's start seeing some 50s. Let's start pumping the brakes because we were already feeling it as consumers then. See, Wall Street wasn't feeling what Main Street was feeling, right? And we're the Main Street part of it. So no matter where you're watching from around the world, there's that dynamic, okay, between your bigs, right? Your high up there's whether it's money-wise or, government politics-wise, and then the people that are just your, I guess, ordinary class citizens, people like me, people like you. So what happens is we get the brunt of it. So that's what we're dealing with the Fed here. And let's get to some of your other comments. Happy birthday tomorrow for Scooter. Let's all wish Scooter a very happy birthday. Scooter chimes in saying, what if they ended the lawsuit on my birthday? That would be an amazing birthday wish. Minimal chance, sir, that is going to happen. Maximal chance, though, that you are going to have fun on your birthday. So let's all wish Scooter a very happy birthday. We got Virtual Unknown chiming in, probably driving on the road. Hello, kind sir. Miguel Santos, you're right. Food was the killer in that latest CPI report. Okay, they break it down into different sectors. If you've ever done a breakdown of one, they're actually really kind of cool. Food was bad. Like 20-something percent. I thought it was 20.3, 20.6. It was really, really crazy. Food was just horrible. All right. So honestly, food's a nasty one. And yes, there is definitely still a chance that they could settle, but the chance is minimal. But if I could quote the great movie Dumb and Dumber, so you're saying I got a chance. Yep, 1 in a million. All right, so now heat map. All right, what we're going to do, we've got it right now for the 1-day 24-hour performance. You can see over the last 24 hours, markets are generally up with XLM and XRP down slightly. Why? Because they had the rallies yesterday compared to Bitcoin and Ethereum. We had the video on that. All right, but what we want to look right now is there any fear or is there any positivity being priced in the market over the last hour? So now I've got the heat map up for the last hour. And you can see over the last hour, Ethereum is up almost 2% to 1370. Bitcoin almost at 19.5, 19.493, up 1.47%. XRP 39.5, up just a fraction here. And we got XLM at 11.3, up almost 0.75%. So the markets right now are looking at a bullish pricing manner. Look at the moves that we're seeing right now here leading up to the Fed meeting. This is happening live right now. These are your moves right there. So waiting for Jerome Powell and the Fed to come on, hang out with us, tell us if he's going to drop a 75 or a 100 basis point hit. We've got Shortwind in saying thank you for all your videos. Thank you everyone for all of your views and support for the channel. I'm super appreciative. I'm actually enjoying this quite heavily. Like, honestly, like I'm liking this more and more, and I'm liking the interaction with the fans, and I'm liking the idea that we got more people interested in watching Senate hearings. We got more people here watching, right, Jerome Powell and the Fed. This is getting people excited about their future, getting excited about government, geopolitics, and finance. Exciting stuff, everyone. But yeah, so Jerome Powell and the Fed about to go on in 35 minutes. What I'm going to do is I'm going to give you a little bit of B-roll, get a few more things set up in the background. We're going to put the heat map up on the screen. If you have questions, let me know what they are, and what I will do is I will start answering them. And a big thank you to Ben R for supporting the channel. Ben has been with us for a long time, everyone. Long supporter of a channel. Thank you again, Ben R. And we're just waiting for Jerome Powell and the Fed. He will be coming on at 2:30 Eastern time. Now, as always, anything you see in this video will be linked in the description below. Yes, everyone, I've got the links to the hearings so that if you want to watch the thing in entirety later, right? If you have to miss some of this, you got to go back to work and all that stuff. Hey, this is where you can find the information linked in the description. If you have any questions, comments, anything like that, put them in the chat. We will get to them. I'm just getting myself a drink and a snack and just giving you guys the awesome heat map. And again, super thank you to Ben R for supporting the channel. Thank you again, sir. And while we got people chiming in, let's hear what you guys think. And yes, Ben, I do have the drawing hung. It is hung up actually in my living room. For those of you that don't know what we're talking about, I got a super, super awesome drawing from Ben's brother. Give me 1 second. Let me get that. I will bring it right back here. I've got it in my thing. Hold on a second. All right. For those of you that don't know, I got this from Ben. Ben's brother made it for me, and it is actually the coolest. It's like a total legit drawing. Let's see. I'm trying to get it to where the glare isn't so crazy. Hold on, here we go. There we go. Now you guys can see it a little bit better. But this is the picture that I got from Ben. Really, really cool thing here. Yeah, I've got this up actually in my dining room. Awesome picture, and what it does is it reminds me to keep working hard and to keep working at it. But like I said, Ben's been a long time supporter of the channel, so I super thankful for Ben. And I also saw something else here. Let me go to that. I can go back to the chat, everyone. I also saw War Galley chiming in with a membership. Well, thank you very much, War Galley, coming in as a super supporter. But yes, Ben chimes in saying, hey, do you have the drawing still hung? Well, not now, because I just showed you, but yep, it's going to go back up in my dining room. Love it. And by the way, everyone, heat mat that's up on the screen right now, if you see it changing colors, I have the heat mat set to a 1 hour interval. So everything you see right now is going to be over that last hour time change. So if you see it bouncing back and forth, it's all going to have to do with pricing coming in with Jerome Powell in the Fed, and we've got it coming up here soon. Like I said, at about 2:30 Eastern time, he's going to be coming in. So again, thank you, Ben R. Virtual says he thinks more is going to come in. He thinks the pricing we're going to see is going to be way higher than 10 or 20x from where we are right now. What do you think? Let me know in the comments. Akeem Muhammad says maybe we'll see some nicer entry point first before the big run. Not that these aren't nice. These are nice entry points, but here's the whole thing. The thing is, everyone, we still have a lot of global turmoil that we have to deal with. This whole global thing is far from over. Okay, do you remember a few months ago we were talking big about Luna UST? We were talking about all that kind of stuff, you know, crypto crash, crypto contagion, you know, all that. And now you really don't hear about it too much. Well, you're going to start hearing about it soon, because we're going to be hearing about liquidations here based on these points if they go any lower. But what you really haven't heard about crypto contagion too much. You haven't heard about leveraging too much. We've gotten through that. Now we're dealing with the inflation stuff. All right, so now that once we're done dealing with inflation, we're going to move on to the next thing that's going to tug the metric, all right? The next thing that affects the economy. Now here, the next big problem that we have is we still have a massive worker shortage. And that has to do with companies wanting to keep profits. It has nothing to do with a worker shortage. It has to do with company wanting to keep more profits. There's tons of jobs out there that aren't getting filled. Companies don't want to fill them. Tons of reports are coming out right now where people are saying, hey, I'm well overqualified. I'm not even getting the calls back from hundreds of applications. Businesses are saving money right now. They're cutting their costs. Let's see. War Galley says, yes, that is a nice drawing. Yes, it is super. It's a legit drawing. Like, the detail on it is freaking cool. And the drawing itself, everyone, real quick, just to give it, I mean, it's heavy. Like, this is, like, seriously heavy. In the picture frame here, this has got to be, I would say, 18 inches tall by probably 24 inches wide. I'm assuming that's what it is right here. Like, this is, like, legit heavy. So thank you again, Ben R. I have this in my dining room as a reminder for me that I have to just keep on working hard, keep on pursuing, keep on doing what I can. So thank you again, everyone. Let's see. So Max Magato says it's going to be 100. Everything is going to drop so hard. That's the thing. What do you think? Is it going to be 100 or a 75 basis point hit? People are saying, hey, Klaus, stop saying FUD with 100. I don't think it's FUD. I think I'm one of the few channels out there that's being realistic, that's not going with the hype. I've been talking about negative prices for a long time. Remember, I think I was the first channel out there publicly calling XLM dropping to a floor of 10 cents, and I took rough heat for it. A lot of people out there were pissed when I published that video, but I had the support behind it saying, hey, these are the reasons, and they're coming to fruition now. I really think, though, that the future problems that we're going to be dealing with, things are going to be freakishly expensive. I think you're going to see a retraction in consumer spending next, okay? So when, we're dealing with, CPI, inflation and all that stuff, the next thing you're going to watch for, consumer confidence, all right, and consumer spending shrinking. And here's why. You want to buy a house, you want to buy a car in the next few years, all right? So you want to do this. Do you realize how much more expensive that house and car is now that the Fed is jacking up rates, everyone? It is crazy insane. Let's do it. Let's buy a house while we got some time until Jerome Powell and the Fed come on. Because do you want to watch the Fed commercials? I mean, if you want to watch the Fed commercials, I'll subject you guys to torture. And what's up, Twitch Radio? Chime in. But here, let's buy a house. Let's show everyone how crazy this is going to get. So let's do a mortgage calculator, all right? And this is now going to be without taxes. Let's just not do taxes. Let's just talk about just the home purchase. And I hate when you have to click on all these stupid things. So you can go F yourself. I'm going to a more basic mortgage calculator. All right, so let's do it. Let's buy a home. $400,000. All right, we're gonna put $20,000 down just to make it easy. All right, the loan amount is for 3D interest rate. All right, so before the Fed was going nuts, all right, before the Fed was going nuts, everyone, all right, your payment for that $400,000 loan was $2,020 a month. That's before the Fed went nuts. And so everyone out here is like, well, why is the Fed jacking up rates? It doesn't solve anything. The only thing it does is it squishes money out of the pockets of consumers. So now the Fed, right, if they drop a 75 today, we're talking 225 in the near term. So now we're going to add 225 to this. So we're going to make this 5.75. So that same $400,000 home, right, 3-4 months ago, will now cost you way, way more. It will cost you how much more? $650 more a month. A $400,000 home, which is not crazy in the United States. Let's be realistic here, everyone. A $400,000 home in the United States is not out of line. All right? But because of the Fed's actions, they now have raised the rates. If they do 75, well, that would be 225 basis points, raising payments $650 a month, everyone. That is a lot. Think about that. So that's $650 a month. Now let's just play a little bit more devil's advocate here, right? Let's just kind of roll it through because that's what we do as educated people here. That's $650. We want to do that over here. So how much more did the Fed cost someone who wants to buy a home in the next couple years? $7,800 extra dollars a month comes out of their pocket. Now, wait a minute. We are not done yet. We're not done yet. Now, this $7,800, right, that comes out of your pocket, that's after you pay taxes, okay? So, let's just throw it in there and let's just be conservative. Let's multiply ourselves a 30% kick on tax, which is going to be conservative. That means the Fed, because of them raising rates, to quash down, all right, the demand side of things, because the government's not fixing the supply chain stuff. They're not easing restrictions. Businesses sure aren't doing what they need to do to crank up production. You guys know that as well as I do. They've been operating on thin margins to maximize profits. So the Fed's action right now over the last 3 months, $10,140 is being taken out of your pocket on an annual basis if you want to buy a home right now. Jason N chimes in $650. Yes, Jason, in the matter of 3 meetings, at the minimum, we are going to see 225 basis point hit, which would raise a home payment, a standard home payment in the United States by $650 a month. And here's the worst part, everyone. We're not even close to being done. No. We are not close to even being done. We are talking right now, looking at this being this is going to continue. So this 3, whatever we're going to see, this 75 basis point hit over and over, and the Fed has not come out yet. Mellitus constus, sorry, my bad about that. But yeah, that's what we're saying. The 3 last hikes have raised the rates for buying a house $650 a month. And so we're not done yet with the Fed. The Fed's not done yet. Let's say the Fed over the course of the next 9 months, okay, let's be real here. Over the course of the next 9 months, let's say the Fed has to raise it, I don't know, 2.25 more. That's not out of the way. They've already done it over the last 3 months at the minimum. So over the next 9 months, you think it could happen? Yep, that easily could happen. That would then put rates at what, everyone? 8%. So let's hit it. So that $2,000 a month payment on a standard $400,000 home was what, everyone? Was $2,000. And now at 8% is going to be $3,200, everyone. The Fed's action against the consumer by raising rates is going to increase the average home payment for a new home buyer by $1,200 a month, more than 50%, 60% increase in pricing. 60% increase. And that's only if the Fed raises it 225 basis points over the next 9 months. We know that is a total huge lie. We know they're going to just keep coming at it. Everyone, we could look at 8 to 9 to 10% interest rates for home loans for a 30-year loan here when all is said and done. Inaction by government leaders out there, inaction by business leaders out there, not doing what they have to do to make things more streamlined without affecting the quality of their product, without affecting their workforce. Those problems here are not getting solved. So the Fed comes in, drops the ugly hammer on crypto, drops it on the consumer. Here you go, everyone. 6-7 months from now, the average person looking to buy a home will be spending $1,200 more a month on their payments because of the Fed. How is that fair when it is governments and big businesses out there not doing what they need to do to open up the supply chain? In the United States, all right? And I know, I'm getting a little carried away, but this all has to do with crypto because crypto feels the brunt of it. Here we go, looking at the pricing right now. All right, look at it right now. You're seeing pressure. You're seeing pressure on XLM. You're seeing pressure on XRP doing the same thing. The algos are trading the same. The bots are trading it. Massive pressure on the American consumer right now. Completely unneeded in the United States. When Rona hit, we had a shortage of lumber. We weren't allowing lumber to come across from Canada. Lumber prices in the United States went through the roof. Well, then you know what you do to fix that? You open lumber production in the United States. You give short-term incentives. You make it happen to get yourselves through. The government, much like the Titanic, is a super, super massive ship. They couldn't steer the Titanic out of the way, or the captain at the ship was drinky. But anyways, they couldn't steer the Titanic. Neither can the government steer our Titanic of an economy fast enough to make these changes. So on the consumer side, we bear the brunt of the Canadian and the U.S. government blocking the borders there. And it drove up the price of building materials. You saw that too with copper. Anyone out there in the building material sector, anyone out there building a home, doing a renovation. When the Rona first hit, the first month was nasty. Second month was nasty. Then it just picked up and went crazy. It was nuts. The KJ Forever says, you cut trees down, look at the Mary Janeage market. Very, very true. They've held that back. The government has held back the green industries. And I'm not talking about green energy. I'm talking about the fun green. The government's held the funding back on that as well. Why? By making the tax part of it rough. Right? Any Canadian importing company is getting screwed on the taxes. Again, see, that's my point with everything that I've been trying to do with this channel. Educate people on what's going on, not the politics, right? The politics are a game, but what's really happening financial strategy-wise. Right now, governments, businesses are not helping out, all right? Are not helping out with supply chain basis. They're not. I mean, come on, guys. Like, let's be real here. Should food prices really be where they're at? No, there's no reason. We're all back to work. We're all doing what we need to do. We don't have enough people to do what we need to do. Companies really aren't hiring because they're sticking the pockets or the profits in their back pocket. Frustrating to say the least. No, the announcement is not out yet. Jerome Powell and the Fed will be talking at 2:30 p.m. Eastern Time. And as always, any articles you see in this video or live stream will be linked in the description below. And yes, as soon as this video is over, it will go in the live stream folder. So if any of you out there are watching and you missed it, don't worry, it'll be in the live stream folder for you. Now, let's rock it back to the heat map. All right, so like I said, heat map right now up on the screen is representing, all right, the last hour in performance. You can see the last hour markets, everyone, are pricing in negativity going into this. Twitch Radio chiming in. Just paid $8 for a bagel the other day, so I'm going to say no. Twitch, you would be correct. Things are not right with food. It's nuts. The government is just in the way everywhere. It's a total mess. Dom says, I hope your day is going well, Klaus. Dom, I hope yours is going well. And Dom, thank you very much for the continuous comments. I see him. I reply to him. Much appreciated, Dom. Crypto Experiences, I know where that is. I've only been here a year from Newark. Oh, that's because you and Ben are talking about where you guys live. Thanks, guys. I like that because that means we are making friends in the comment section. If you have any questions, comments like that, put them in the comment section. Scooter chiming in saying 75 basis points, 80% odds, even 85%. The Fed comes in with 75. 15% says 100. I ain't no way in hell they're going to do 50, and ain't no way in hell they're going to do 125. So, you know, just saying, not going to happen. So, yep, we're hanging out right now, waiting for the speech from Jerome Powell and the Fed. War Galley's chiming in, and War Galley chiming in as a new member, everyone. And thank you to the members out there, Twitch Radio, Ben R, and War Galley, who are watching, chiming in. J-Dub Digital saying, what's up, Klaus? What's up, J-Dub? How are you? Yeah, thank you guys for the support. But, okay, right now, seriously, with how the Fed has been, the Fed has not reacted swiftly. They've not reacted promptly, okay? So what we've seen is the Fed has always been behind. They've always underestimated inflation. Inflation is transitory. Inflation is going to be something that spikes and then down, all right? So anyways, the deal here is that what we've seen from the Fed is constant inaction. So when I look at that 100 and 125 basis point hit, I don't see any chance of the 125. I see that way too far forward thinking for them. The 100 I see as a small chance because it had to do with food and energy on the last CPI report, which was just crazy. And we know they're going after the American consumer. It's crazy. It's totally crazy. So we're waiting right now, 2:30 meeting from the Fed. I have it up on the screen. I've got dual feeds right now. We are waiting for the stream, everyone. And if you have any questions, throw them into the comments. We got Delta Ghost chiming in saying, I'm going to spread the word on this channel. That is the nicest thing that I can hear. Compliments like that are well appreciated. So thank you for that, Delta Ghost. War Galley chimes in, figured it was finally time to bite the bullet, so to speak. I appreciate it, War Galley. And everyone else out there appreciates it because the support from this channel goes to improving things. So what I'm doing today, I'm busting my butt with this live stream, all the prep for it and all this kind of stuff, all the links and everything that we're doing. I'm busting my butt today so that I can buy a used Elgato mini deck so that I could switch feeds. So like if we have two different things going on at the same time, I could simply hit a button, switch feeds, or I could switch like a sound feed to a visual feed and split it out. So that's why I'm working so hard today so that I can get an used Elgato Stream Deck Mini so that I can increase the quality of the live stream performance too. So now back at the comments. Patrick Burns is looking at possible 20% here in the UK. Wages increased 5% over 2 years. Yeah, and Patrick, earlier, you know, when I was talking about how much homes cost and all that, I was talking about homes being that much. That everyone, that's just based on short term. All right, the pain that we're dealing with right now, it really seems that we're going to deal with this for a while. All right, and what you're seeing here in the United States is what you see in the UK. It's what you see in Canada. Rates across the globe going up, everyone. So that $400,000 house, right, that we're going to buy, Jerome Powell and the Fed within the next year are going to make that $400,000 house payment go up by 60%, $1,200. All right, Twitch Radio chimes in saying, I've been surfing YouTube channels and listening to people talk about crypto for at least 5 years. Immediate Wise class has the best channel out there to date. Well, thank you for chiming in with that, Twitch. And yes, I know text to talk or talk to text hates you. I totally get it. But yeah, I think what we're looking at today is 75. I'd honestly, I know it hurts, guys. I trust me and gals. I know it hurts. But I would love to see a 100 basis point hit. Let's just rip the freaking Band-Aid off. Let's just hit the bottom, get it over with, and get it done. In the financial crash of 08, you remember like Lehman Brothers, remember the whole idea of like too big to fail? I was one of those people out there that my belief system was, no, let them fail. Let's just get this over with. Because if you don't let them fail, then the taxpayer pays the bill for it. The taxpayer pays the bailout bill. And that's what we're seeing right now. You know, all the money that's been printed in the economy lately, it's having this exact effect right now on what we're paying for prices. These big businesses out there know that people were pumped tons and tons and tons of money. Tons of money came out with stimmy checks. Tons of money came out with loans that shouldn't have gone to people. There was a lot of money out there pumped in the economy, and businesses aren't stupid. They're like, hey, look, we know there's a lot of cash. We can rake in the cash. And to rake in the cash, we're going to keep our prices way high. We're not going to hire more. And boom, that's how we're going to make our money. Profits, by the way, for gas companies. I don't know if you guys have seen that the last quarter. Record-breaking profits for oil and gas companies out there previous quarters. So you can't tell me that these companies are hurting for money. You can't tell me that egg producers out there are hurting for money when you could get them at what, everyone? Like $8 for like 2 dozen? Like, that's crazy. That is totally crazy. They're just taking advantage of the public. And right now we are waiting for Jerome Powell and the Fed to go live. He's going to be going live at 2:30 p.m. Eastern time. Just waiting for it to happen right now. We've got about 9 minutes until Jerome Powell expects to go live. So if you got any questions, comments, anything like that, put them up in the chats. We will get to them. Like I said, we got 9 minutes till JP and the Fed goes live. I'm going to give my voice just a real quick break before we go on. And we got Jimbo Tango joining us from Ireland, everyone. Hello back to you, Jimbo Tango. About 6 minutes until the Fed's Jerome Powell comes live. Big shout out there for Jimbo Tango. Thank you so much, sir, for helping out support the channel. Again, we've got viewers from all over. Why don't you help myself and everyone else out? Let me know where you're from in the comments section. Thank you very much, Jimbo Tango. We're just waiting for Jerome Powell and the Fed to come out here in just a few more minutes. Jimbo chiming in saying that 100-pointer is coming out today. I don't know. We've got, I'm saying 85% odds with a 75 basis point hit, a 15% chance of 100. Let me know where you're coming in from and what you think we're going to see today from the Fed. All right, we're just waiting for the live feed to come in. Let's get you caught up real quick on some pricing right now. We've got Bitcoin down just under 1% right now, floating right at 19,000. Ethereum still a lot of pain, even though we've got the merge, everyone. 1338 right now. XRP up 41.1, up 4.4% in the last hour. XLM up 2.2% to 11.4. Definitely seeing some separation between XLM and XRP, not XLP, XRP in the marketplace. I did a video about it yesterday. Really obvious separation here with it. Right now, we're just waiting for Jerome Powell and the Fed to come on live, 2:30 Eastern time. We've got about, it looks like 1 minute until they do it. Till then, we're going to go to the heat map. I'm going to switch over to the chat, and we will see what he says. All right, here we go, everyone. Let me know how the sound is with this. I'm gonna see how much oomph I got left to boost it. But as soon as he starts talking, let me know what you think on the sound as soon as he starts talking. Thank you.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 of a percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators.
Real quick, look at the reaction right now with XLM and look at the same one with XRP. Amazing to see the movement, everyone.
Point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance.
And if you didn't catch what he said in 2024, that is when we start expecting to see more GDP growth.
Changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was.
All right, so he's going over some old data, kind of some revisionist history right now. But I want you to take a look right now at the XLM BTC comparison, okay? Look at this. Okay, so on BTC right now is in sky blue, XLM is in purple, all right? And this is now just about a day and a half. I've got this at window. What I'm really focused on is this. Look at that move right there. Look what happens. with the amount of inflation being identified at 75 basis point hit, right now you could see that XLM went up on the announcement of 75 at the same time as Bitcoin was going down. Total decoupling. Now let's compare XRP to Ethereum, because I see your comments right now. I see it. You guys keep talking about decoupling, and we've been talking about that on this show. Let's make Ethereum red, right? Bad Ethereum. Look at that. The same thing you're seeing right now. Let's make it just a little bit cleaner on the chart so you can see it. Look at that. As XRP went up, Ethereum went down on the news, everyone. Really, really significant here to see the decoupling.
8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving.
And yes, Ethereum just recently completed their merge from proof of work to piece of shit. Proof of stake, my bad, everyone. Sorry, back to Jerome Powell.
The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025. Still.
Yeah. Okay, I get it, Jerome Powell, and your projections. Look at the market right now, especially specific. Look at XLM and look at XRP. Let me clean up Ethereum out of here for everyone. And look at XRP on this action here. XRP and XLM are loving this action. We're starting to see decoupling, and we're also starting to see the market look at things a little differently. All right, so now we've got the heat map up on the screen. This is now for the last hour, okay? So you could see that leading up to it and going into it, Right now, we can see the markets are green across the board, everyone. Ethereum, though, nothing to write home about. 1353, up just 0.89%. Bitcoin, 19,372, up just over 0.6%. Jerome Powell and the Fed coming in, dropping a 75 basis point hit, saying, hey, we're going to keep going until we drive the inflation rate back down to 2%, everyone. Yes, look for continuous amounts of rate hikes to go up until it comes back down to that 2%. And so the CPI data for the last month came out at 8.3%. So think of how much more pain we have to go. So now, speaking of pain, so what does the Fed's rate of 75 basis points mean today? It means that consumers are going to be spending a hell of a lot more money on interest. Now, let's take an average home in the United States at $400,000. All right, at $400,000, before the Fed was doing anything, everyone, that average home only cost you $2,000 a month. But now, after the Fed raising their rates to what they have, we are looking at a home loan that is now, how much, everyone? $650 more. Now, the Fed says they're going to go even more and more and more. So now imagine the Fed raising rates over the next year. How much is that home loan going to cost you when all is said and done? When the Fed is done raising rates, trying to get inflation back down to 2%, that same $2,000 a month payment from a $400,000 home, after the Fed is done putting their hands in everything, jacking up rates left and right, that same house is going to cost the American consumer $3,500 a month. That is an increase of 1,500%. That is a 75% increase in the payment for buying a home a year from now. Think of the pain that the consumers are going to feel. And I know a bunch of you out there are saying, Klaus, hear me out. Home prices are going to go down because rates are going up. And here's what I'm going to tell you. Home prices are going to cool down. I don't think they're necessarily going to go down. Why? Because private equity groups are out there buying up homes and they're renting them. And what they're doing, they're raising the rent rates, forcing more people to buy, creating more demand on buying homes. If there's high demand on buying homes because rent's going up, that means what, everyone? Home prices are going to stay up. Yes, we're going to have home prices staying where they are. Don't look for them to crash because private equity is propping up home prices. So now you're going to have these same expensive inflated home prices with now the Fed putting interest rate hike after interest rate hike to it, increasing the payment. I just did the math on it here for everyone right now. And this is okay, so real quick, for those of you just catching up, 75 basis point hit is what they did. 75 basis points from the Fed. But the typical home now from the Fed is going to cost, because of the Fed's action, is going to cost the average person $1,500 more a month, everyone. So if you know someone who's going to be buying a home here anytime soon within the next year, they're going to be paying more. Buying a car, you're paying more. Credit card loans go up. The costs of businesses go up. Let's get back to JP. See what he's got to say. He's taking questions.
To see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time that you could see pausing? Is it linear that you keep raising rates, or is there, oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility, certainly, that we would go to a certain level that we're.
And if you got any questions or anything like that, put them down in the comments below. We've been talking how the Fed's rate hikes have been affecting home purchasing. But let me know, what are your concerns right now? Hit us up in the comments. We're going to keep listening to them.
In the view of the committee, there's a ways to go.
Hey, Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. And as I've said, there's no basis for complacency there. But to the extent that
So we had a question, what is going on with ETH? All right, so here's the thing with ETH, all right? So ETH is used very differently than XRP and XLM, and here's what I mean by that, okay? When companies, businesses do loans and stuff like that, when they have some of their holdings and some of their collateral is actually in Ethereum, all right? Some of their holdings is actually in crypto, all right? Think of Michael Saylor and MicroStrategy. On their company's books is actual Bitcoin, right? Musk has the same thing. He's got Bitcoin on his books. People use Ethereum for loans, it's collateral for loans all the time. So what happens, and this is why ETH and Bitcoin really, really face way more direct pressure than the rest of the market out there, it's because of these liquidations. So here's what happens. There's loans out there that say, hey, look, if Ethereum gets to 1,300, you either have to pay us your loan or we liquidate you. That's the deal, right? So what happens is people can't pay these loans back. So when it gets to 1,300, boom, all that ETH gets sold, it gets dumped. So then we get to the next one. Now you got a whole bunch of loans that now will go expire at 1275. And we're talking ETH right now. Expiring at 1275. So then once it hits 1275, same thing. Hey, you pay up your loan in full or we liquidate you. We tax that ass, right? Boom. So more and more, it just keeps being pulled down. Why? Because Ethereum and Bitcoin are used as a storer of value for a lot of companies. They're used as collateral on loans and assets on books. So for why is Bitcoin and Ethereum are taking such a beating? It's because right now, companies, people out there are putting a lot of value in cash, even though it's getting beaten up by inflation, and people are putting a lot of value in precious metal holdings. But right now it's cash on the sideline, so people are pulling money out of the digital holdings, right? The digital assets. Look at what Saylor did with Bitcoin. Look at what Musk did with Bitcoin. They all dumped it. They dumped it. Musk dumped what, 75% of his Bitcoin? So there you go, in favor of cash. So let's get back to Jerome Powell. But yeah, keep the questions coming. Awesome. 75 basis point hit right now from the Fed's Jerome Powell.
Really added value in terms of understanding where the labor market is.
Nick?
Nick Timmeros at the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform.
And again, a special thanks to Jimbo Tango and Ben R for supporting the channel. Thank you again, you two.
An estimate for where you think the underlying inflation rate might be in the economy right now.
Well, so, again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lengths, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see.
Real neat to see XLM and XRP making some big, bold moves here, leading into and during the announcement of the Fed's 75 basis point hike. We are definitely seeing a decoupling happening from Bitcoin, Ethereum, and the rest of the market. Again, XRP and XLM definitely starting to decouple. Exciting stuff.
Positive real rates across the yield curve, and that is also an important consideration.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a
And huge shout out to the KJV Forever saying, send this man some love. Thank you for the donation for the channel. We're listening to Jerome Powell, the Fed, letting us know about the 75 basis point hit, XLM, XRP, decoupling from Bitcoin and Ethereum. Look at the movement here, everyone. This is great. Thank you again from the KJV Forever. Let's get back to Jerome Powell and the Fed.
For the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about this.
Fair warning, Wig Bust is in the house. What's up, Wig? Good to see you here.
Of overdoing it. What's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby. Thank you.
You know, real quick, before we get into the next question, we got a viewer chiming in saying, 8RG Leo saying, thoughts on ADA pumping high. All right, now remember, Vasil Hard Fork, everyone, is going live tomorrow. Now, a lot of the pricing action for these events happens way, way early. Are we going to get more kind of pump from tomorrow? We might get a little bit more action, but what we're noticing, look at the comparative action of ADA versus, look at XRP and ADA. XRP up 8.83% in the same time period as ADA, and you've got Cardano's Vasil Hard Fork going live tomorrow. So where is the market placing the action? Right now, you're seeing definitely more action moving on the XRP side, but I am happy to say it is good to see some green with ADA, especially with the hard fork coming up. The last thing that I wanted to see was Cardano have a bad day today, a red day today leading into the Vasil hard fork. That would have been a complete mess. Even if you're not an ADA fan and you're just a crypto fan altogether, that is not something we want to see in the crypto world. We don't want to see big projects fall on deaf ears and the price go red. And again, thank you everyone for the support. I'm working hard today so I can get myself a used, yes, a used, because I don't need a new one, a used Elgato Stream Deck Mini so I can have multiple feeds swapping back and forth to make better live streams for you. Let's go back to Jerome Powell and his 75 basis point hit.
Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I mean, I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so.
Oh my gosh, brilliant, brilliant question. She just called him out and said, hey, look, if you know things are going to be bad for a while, why not drop the 100 basis point today? Well, he didn't do it. Again, Jerome Powell and the Fed have been soft. That is what has had a bunch of us upset out there, is for a year now we have been saying to the Fed, whoa, 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 you need to start quantitative easing. You need to get rates under control, right? We were calling for that a year ago, and here we go. She asked him, why not do a 100 basis point raise? Let's see what Jerome Powell has to say.
So we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. So that's how we think about it.
Great. Victoria.
Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now and not something I expect to be considering in the near term. It's just, it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Neil. Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of?
And before we get to the question on, hey, how does it affect the globe when all the central banks start tightening up their monetary policy? We got a really interesting comment in here. New Anomaly Production says Powell seems way more comfortable this time. When he hiked it 75 last time, he was shaking. Yeah, last meeting that we had when we covered it live, Jerome, he didn't look good. Like he almost looked nervous. Kind of like he had, not that he had never done this before, but he was almost like afraid to give the information out. With this 75 basis point here seeming so comfortable as a decision from the Fed, I think we have to really start thinking about a 75 basis point hit easily on the table for the next time. Easily on the table for the next time. So we're talking over the last 4 meetings looking at 300 basis point increases. Other important things to see is we've got XLM, XRP separating themselves from Bitcoin and Ethereum. Let's get back to Jerome Powell and the Fed.
Of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always take all of that, try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about, the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times. But really, we're in very different situations. But I will tell you that our contact is more or less ongoing. And it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And
yeah, their feed's a little crackly. He's going to be basically asking Jerome Powell, hey, why didn't you do this stuff sooner? Let's see what they say.
A possibly higher terminal rate.
You're right, of course. The labor market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest-sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. You know, this is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's.
Whoa. I just wanted to interject. Right? Did you catch what he just said, that there is still plenty of savings out there to account for growth? See, this is where the Fed messes up. See, there's not a lot of savings out there because right now, the savings that's getting eaten up is being eaten up by high food prices, high fuel prices, high housing costs, all of these things caused by the Fed. So no, there's not going to have, the savings isn't there for growth to happen from the retail sector. The only people that have savings right now are the businesses that got all the extra funding, the states that have the extra funding from the feds that still haven't spent it from all the previous bills that have come out. Sorry, I just wanted to make sure that you guys all caught that, because again, he's saying that the American consumer right now has enough savings to withstand continuous rate hikes, everyone. That is arrogance, total mess right now. That really bothers me. And we got Vegan and BB Justin chiming in. Good to see you here, sir. Let's get back to it.
There's a good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that. And
yeah, and Monarch, thank you very much for bringing that one out. Monarch says the savings he's talking about are the people's, not the government saving, talking about our money. You know, and that's exactly right. All of the money that was pumped into the economy that made its ways to these big businesses, right, now making its way to banks, right, that are going to be jacking up interest rates, that all came out of taxpayer dollars. That's why I'm so mad about this, because this is a problem that the Fed caused, that they're swooping in to try to be the hero of, but now they're making it worse for everyone. So great catch right there, Monarch, with your comment.
You know, that's a good thing, because that means the economy will be more resistant to to a significant downturn. But of course, we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here, with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then, given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
And real quick, the reason why this inflation stuff was so bad and warranted yet another 75 basis point hit, I've got the last CPI data report up on the screen. You could see here, all right, energy costs up 23.8% on this last report. Food up 11.4%. Energy and food, things that directly hit the consumer. That's why these rate hikes, they're hitting consumers even harder, because now we're paying for high food and energy costs, and now we're going to be paying even more on credit cards, home, auto loans, home equity lines of credit, you name it.
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. That's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well.
And real quick, for those of you out there that are listening and watching, all right, what I want to share with you is the next CPI data. All right, so check it out, everyone. If you're looking to see how is the market going to be pricing in action, the next big date that we have to deal with CPI data is this: October 13th, 2022, 8:30 a.m. Eastern Time. Yes, everyone, that is going to be October 13th, 2022, 8:30 a.m. Eastern Time. That is when we're going to get the next set of data for CPI, the September 2022 data.
We're never going to say that there are too many people working, but the real point is this. Inflation, what we hear from people when we meet with them is that they really are suffering from inflation. And if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
Thanks. Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability, and you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that inflation, high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion, and this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment, and the way we do that is by slowing the economy. Hopefully, we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So, you know.
Oh, I'm sorry. Jerome Powell just said the delay will likely lead to more pain. Anyone who has been watching this channel, other channels out there, we have been calling for the Fed a year ago to start raising rates, to start curbing inflation, because we were already feeling the pain as consumers. Main Street was feeling it, and we said, Fed, stop delaying, because if you delay, there's going to be more pain. And what did Jerome Powell just say? Well, you know, if you delay it, there's going to be pain. Well, then, Jerome Powell and the Fed, why did you delay and wait so long for raising rates and working on your balance sheet? Total hypocrite right here.
I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down, you know, significantly over the course of next year, and then more the next year after that. And you know, I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that, you know, that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs, and we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period.
I think you guys are all thinking the same thing that I am, judging by your comments here. Yeah, Jerome Powell, who are you serving? You're not serving the American people. I mean, you're definitely not helping out the American people. Everything you've done here has benefited big businesses without any sort of trickle-down benefit through your actions.
Very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen since we started keeping track of that. So we want to get back to that.
Okay, real quick. I got to do this. I got to share this with you guys because someone just brought it up. All right, here we go. I'm going to talk about this. All right, I got to do this. All right. So I was just reading a comment, and we're going to get back to Jerome Powell and the Fed. All right. But Yates Doan just put a comment out there that I'm going to give a gold star to, and I'm going to use it as a huge talking point. Everyone watching the stream, listen very carefully. I want you to apply this concept with crypto. And Yates Doan, you are the man for this comment. Yates Doan says, print more money and keep trying to pay more money when less goods are available because businesses go under, right? And so what do? You print more money to pay for this. You print more money to pay for this, right? How many of these altcoins out there are now in version 2.0, where they're minting a new token in hopes to raise money to pay for the original debts of the original token? Doesn't that kind of sound exactly like what the United States government was doing, which caused inflation, which was a mess? How many projects out there have I called out personally on this channel that are now minting a new set of tokens with new rewards and new rules? Why? Because their original one is so far in debt, they had to mint a new one to cover the payments of their first one. So for Yates Doan out there that said, hey, print more money and keep trying to pay more money when things aren't there. Yeah, think of the crypto projects out there. There's some big ones out there, everyone, that are on now to version 2.0, right? They're printing money, minting new coins to pay for original debts, which would be their original token released, because it was a flop. which will cause more inflation, which then ends up becoming a pyramid scheme.
But to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises. And so we want to avoid that. We want to act aggressively now and get this job done and keep at it until it's done.
Nicole from CNN. Thank you, Chairman Powell. Nicole Goodkind, CNN Business. Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008.
Real quick, while she's asking her question here, does Jerome Powell seem extremely comfortable today? I mean, does he really seem like, I don't know, maybe like this decision, like they knew it a while, like this is, it just, he's so much more composed, so much more relaxed this time around. Not that I'm saying he maybe dropped a ladder or two, Mr. Zanny Zan, but that look at him now. Don't focus on what he's saying. I've got it muted. But just look at now how he's talking when they show Jerome Powell. Way more poised. He's not sweating. He's not shaking. He seems so much more comfortable right now with this last rate hike than he did with the one before. Even during this Q&A, look at his movements. Very controlled. He's not jittery, nothing like that. Very composed. Just something to take a notice of. He definitely seems more comfortable with these 75 basis point hits.
The line so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market, as you know, it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
Shelter made up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think hope for the best, plan for the worst. So I think on shelter inflation, you've just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question.
And we got the last question coming up, but did you just hear what he said about shelter inflation? That's housing, everyone. Expect it to stay up for a while. Exactly what I was saying earlier in the stream, as we're going to see private equity groups remain heavy in the home buying market, buying every wedge property that they can, and then renting it out at a higher rate, driving up the rates in the area for rent, increasing the demand for housing, which then increases the demand for prices on homes because the supply has been so low because they've all been bought by private equity groups. Let's get to the last question with Jerome Powell.
Hi, Jean Young with Market News. You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be next year? How restrictive?
So I think if you look, when we get to, let's assume we do get to that level, which I think is likely. What you're going to do is you're going to adjust that for some forward looking measure of inflation. And, that could be, you pick your measure. It could be, there are all kinds of different things you could pick and you get. But what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term, I think, that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I mean, I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go. Thank you very much.
All right, everyone, that was Jerome Powell and the Fed dropping a 75 basis point hit on us. What's up? Hello, I am back to you. All right, so let's take a broad look across the market. Again, thank you, everyone, for your support. We are sharing knowledge like this with so many people out there. These streams are getting bigger and bigger, and I love it. So right now, we're looking at Bitcoin. Struggling right now, 19,395, down 0.5%. Ethereum, 1356, down 1%. XRP softening up a little bit, everyone. Yep, we're going to get to those individual charts here soon. XRP right now under 42 cents, up 6% in the last hour. XLM at 11.6 cents, up 2.75% in the last hour. Now to move on to the likes of XRP, XLM, individual pricing. Here we go. So you can see we did meet some resistance at that 11.78 mark, and since then have retracted a little bit. But look at the movement of XLM. As the announcement was made, XLM bulls out there were in force saying, hey, you dropped a 75 on us, we were afraid of 100, so we'll buy on that 75. Now we swap on over to XRP, and XRP, the story looks very similar. On the news of the rate hike, XRP was there, and they said, hey, we're gonna buy as well. We saw the movement from around 39.2 cents up to almost 43 cents, with a retraction now down to 41.8 cents. But across the market, we're basically looking at a lot of green, with Bitcoin and Ethereum starting to decouple from the market. All right, everyone, if you've got any last questions, comments, thank you, shout outs, whatever you want to say, now is the time to put them into the comments. We are going to get to them for just a few more minutes here, and we've got a lot of fans reading. And again, I wanted to say thank you for the support from everyone. A lot of the active comments, these live streams have been a blast. When else has been watching Jerome Powell and the Fed? And if you watched it, all right, the Senate committee, right, the Senate Banking Committee, when else was it that much fun to watch government hearings? Back in the day, you couldn't get anyone to twist my arm to get me to watch C-SPAN. Now I'm broadcasting it to hundreds of viewers out there. The previous live stream had over 3,000 viewers, so thank you, everyone, again. But the big stories here, XLM, XRP, decoupling from Bitcoin and Ethereum. The Fed coming out saying, hey, 75 basis point hit. We are so comfortable with it. We're going to look cool, calm, and collected as we screw over the American public. He also said that the Fed is going to keep, yes, everyone, keep raising rates dramatically until we get CPI data, that core inflation rate, back down to 2%. The last report that just came out was at 8.3%. Everyone, we have 6.3% of downward pressure left to go until we get there. This is going to be a very, very painful one. Twitch Radio is saying, I'm out of here. Got to finish up charging my stuff and hit the trail again. Twitch, You stay safe, and you better let me know that you're doing okay, sir. Thank you much for chiming in. Joseph Vene says, yeah, we should yell at the news together. Usually I'm just yelling at the TV by myself. Yes, definitely. We need to get more involved. That's why these live streams are so big. It's Jerome Powell and the Fed, they're going to cause some pain for the consumers out there. They are. The pain is going to be felt directly with the consumers, and you're going to feel it with purchasing a home, buying a car, credit cards, home equity lines of credit, business loans are going to go up in cost. Anything tied to the Fed basis rate is going to become extremely more expensive. So what I am going to do, we're going to get this live stream going for just 5 more minutes. We're going to end at 3:35. Whoa, buddy, I think I hit the wrong number on my keypad over here. Give me a second. We're going to end this one at 3:35. Hold on a second here. 3:35 p.m. Eastern time. So get your thank yous in, get your comments and questions you got in right now before we sign off. But the big stories of the day, CPI data. I keep bringing it up. And Joseph, thank you. Thank you for the comments, Joseph. Thank you for the support. I appreciate it, sir. And thanks for hitting up on these live streams. These live streams are a lot of fun, especially when we have good people participate. But the reason I keep bringing up inflation data, the reason I keep bringing up CPI data is what is moving the markets, everyone. This is moving it. This is the macroeconomic events right now that are moving XRP and XLM. And this last CPI data was a brutal one. That's why markets were sitting here thinking, hey, there's definitely a 100 basis point hit on the table potential. We saw that did not happen. The Fed is continuing their very soft pit-ter-pat approach with interest rates. But the big things to take away from this is energy, right? 23.8%, everyone. Food, 11.4%. These costs are felt directly by the American consumer, and Jerome Powell and the Fed are sticking it to the consumer by raising rates, which is now going to cost everything, is going to make everything cost even more. Double-edged sword here, totally smashing the American consumer. But what else do we got going on right now? We've got Bitcoin and Ethereum definitely struggling. In fact, let's do this, everyone. Let's bring up a little Ethereum chart on here. And like I said, we're going to go till 3:35 Eastern time. So we only got a couple more minutes for you to get your questions in before I log off. Let's take a quick look, though, at Ethereum, because Ethereum is facing massive amounts of pressure. The merge has done what for Ethereum? Not much. Take a look at it now. Over the last 3 months, right, we had the pump run up to the merge. And then you could see, look at that retraction. That is a lot of downside pressure. This 1349 that we're seeing right now, the last time we saw that was July 14th, over 2 months ago, everyone. So Ethereum lovers out there, you just lost 9 weeks of time with this recent downside pressure. So you ETH longs out there, looks like you're going to be waiting even longer. Now, if we do the same thing with Bitcoin, because remember, Bitcoin is the other thing that is facing extreme liquidation pressure. Let's put Bitcoin up here on the screen. So now with Bitcoin, here we go. We got Bitcoin over the last 3 months, same thing. The run up and then the pullback. Look at that 22.3. We couldn't break the 22.3 mark. And here we are back down 19.311. I don't know. I think we're starting to see it. I think we're starting to see the alts break away, because when we take XRP, let's do this. Let's make a mess on the screen. You guys want a mess right before we go? We're going to go like we're doing it Pornog style, everyone. So let's do this. Let's add XLM to the mix. And so what we're going to do is we're going to compare our favorite 2 alts, all right, altcoins. Yep. We're going to compare our favorite 2 alts with our least 2 favorite ones out there, Bitcoin and Ethereum, right? So let's compare it to Bitcoin, and let's make bad boy Bitcoin red. We'll make Bitcoin red, and then we're going to add Ethereum because that is the other one that we like to compare to. And we're going to make Ethereum because it is a piece of shit. Proof of stake, my bad, everyone. We're going to make it a brown color representing the poop. There you go. Have it up on the screen, and this is how we're going to end the chat. We're going to end it with this look right here. Look at XRP, XLM definitely separating themselves from the market. Impressive to see. Over this last month, you could see XRP up 20%, XLM up 4%. Bitcoin, nope, not happening right there, is it? Nope, Bitcoin down 10.7, Ethereum down 20.7%. We are definitely seeing the altcoins starting to decouple from the market. Does this mean that the market is starting to mature? Are we starting to see a new wave of crypto investors out there? And no chat 69XYZ, I don't need that. And you notice that was because I think I said pornog. I think that was kind of funny. But anyways, back to it. We are starting to see decoupling. Bitcoin and Ethereum are decoupling from the likes of the altcoins. Ben is out there saying goodnight. Ben, thank you very much for your continuous support, sir. I do appreciate it. It's pretty late for you right now. It's about 9:35 out there, Ben. Definitely thank you very much, Ben, for your support on the channel. But yeah, definitely Bitcoin, Ethereum separating from the market. Jerome Powell and the Fed, 75 basis point hit, saying more is going to come. If you want to buy a home in the next year, the average home in the United States, because of the Fed, is going to be a payment that used to be $2,000 for a $400,000 home. But in 1 year, after the Fed is, well, not done, but partway through making a mess with interest rates, that same house will cost you $1,500 more. It will cost you $3,500. Yes, everyone, the Fed's action with interest rates is going to make the average house in the United States, the average payment, 75% higher within the next year. So if you think the pain is real bad right now, just wait. When consumers feel it even worse, everyone who's buying a home, buying a car, credit card, it's all going to cost you more money. Ben R chimes in, says, good night, Klaus. Good night, all. Trade Trillionaire says, good night, everyone. Good night to you, too, Trade Trillionaire. Bo Rabbit chiming in. Bo, you made it. Glad you made it. The big news, like I said, is 75 basis point hit. XLM, XRP, decoupling from Bitcoin and Ethereum. We also have the cost of housing going up through the roof because of the Fed. Yep. Auto loans going up through the roof because of the Fed. What I'm going to do, I'm going to kill the camera, and then I'm going to hang out with you guys all in chat, let you say your goodbyes, and say goodbyes with you as well. So I am going to kill my camera feed, and then, oh, here we go, camera feed killed. I'm going to stay up on my mic. If anything breaks, I will be sure to share it with you. Say your goodbyes now, because I'm going to be logging off here shortly. Going to be pulling the plug on here shortly, but I just wanted to bring up the big point I got up on the screen right now. XRP in purple, XLM in blue, Bitcoin in red, Ethereum in poopy brown because it is a piece of shit. Proof of stake. I'm sorry, everyone. But you can see XRP, XLM decoupling from Bitcoin and Ethereum. Look at the moves there, everyone. Those are some big, big moves. Important to see the market maturing. All right, everyone, I'm officially pulling the plug on this live stream. Thank you again to everyone that supported the channel. Thank you, everyone, for your views, watching, and shares. I greatly appreciate your time. That's why I try my best to make every video as concise, as informative, and fun as possible, so I'm not wasting your time and giving you some value to your day. Thank you, everyone, for watching, and have a great rest of your night, day, wherever you are.